If we think of a pilot who is leaving from the West Coast, flying out to DC, and he is 1 degree off, well, then he'll end up in Bangor, Maine instead of in DC.
Well, the instrumentation and measurements are just computer generated. As an airline pilot, you're landing an airplane, but the instruments don't see the fire truck on the runway.
That's John Creekmur, President and Senior Wealth Advisor at Creekmur Wealth Advisors, and Karl Ashley, the Architect and Portfolio Manager of Euclid Investment Advisory's actively managed tactical allocation strategy. We thank Euclid and SIBO for sponsoring the live ETF Think Tank Exchange and this podcast.
We're talking about understanding market risk to help keep your client aloft, aligned with their targeted goals so they land safely. I'm Dan Weiskopf.
And I'm Kedar Wilson. Thanks for joining.
Kedar, great to be here with you. This is the first time we're doing the podcast together. I'm really excited about that.
Yep.
Before we get into the podcast, I'd like to let the listeners know that attending the live ETF Think Tank Exchange enables you to earn CE credits. These are always lively conversations and a great way to learn and earn credits.
Our goal in both the live show and this podcast is to provide thought leadership by bridging the gap between investment producers and the advisors who use their products through actionable ideas.
This podcast offers highlights from the live show hosted by our own Michael Guyad and Dave Armstrong. Our guests talk about strategies to manage risk, offer a peek into their process, including benchmarking and allocation.
Then Dan and I will return with ideas that make a difference. Plus, our advisor guest plugs the charity New York City Relief, an organization that's doing a lot of good for people in need.
Let's get to the highlights.
Yep.
Karl, I want to start with you. I have a fondness for your background. Early in my career, I started out at Honeywell, another great controls organization. And I think that I think finding the threads within what we do end up becoming important. Your background in controls, your background in measurement, and your engineering capability lead you to the strategy itself. Could you start out and offer a high-level overview of the strategy, and then we'll come down into some of the various pieces?
Sure. We have to take emotion out of this and how you feel or think, and see that the computer does a ranking based on a proprietary formula that ranks our investment universe. We then look at that on a strategic sense, and that is a long-term weekly chart that gives us this information. Is the trend up, sideways, or down? And very simply, we rate it as a bull, a bear alert, bear, or bull alert, just 4 of them. And it's color-coded, and you'd be surprised how very closely that analysis, which is visual, matches up with the computerized ranking. It's uncanny how well it comes out to be. Now, why do both? Well, the instrumentation and measurements are just computer generated. As an airline pilot would be, you're landing an airplane, but the instruments don't see the fire truck on the runway. It can't detect that. So we want to have the visual guy looking at things to make sure that everything is proper. Once the determination is that the market is bullish, we can only either go long or stand aside. We could short, but our investment policy does not permit us to short. The same thing is true in a bear market. We can either go short or stand aside. We can't go long. Once you make a determination to go long on a strategic chart, we then take our trading signals and investment signals using tactical charts, which is a shorter term.
And John, I want to bring you in because we were talking about this a little bit pre-show, sort of an untraditional way in terms of how you and Karl connected and how you asked him to develop the strategy. Talk about flowers, you kind of planted the seed, right, through him in some ways. So, what is it that you thought was missing in the market? Obviously, there are not that many strategies that are quite active and used inter-market analysis, but what was the thing that was for you kind of a big reason to get involved here?
Yeah, one of the big things we always hear about walking through index investing. And so many folks hold as a core holding, they hold the S&P 500 inside their portfolios as one of their largest positions, and they build around it. I started looking at the S&P 500 and recognizing, there's 11 industry groupings there. And every single year, a certain number of them outperform the S&P 500 and a certain number underperform. And so as an example, last year in 2020, there was 4 industry groupings of the 11 that outperformed the overall index. There was 4 that underperformed but were positive, and there were 3 that were negative on the year. And so the question in my mind at that point was really, why are we looking at the entire index when really there's a way for us to find out which of the industry groupings are actually outperforming what the broad-based index is? And then from there, within those 11, there was also different subgroupings inside each of the 11 industry groupings. And there has to be a methodology to go out there to be able to determine which of those industry groupings and which of the sub-industry groupings are actually providing more momentum or more upward slope throughout the course of the year, which would allow for an outperformance over the index. And as I got to know Karl and got to really start to dig deeper into his methodology, it became clear that he had really uncovered through mathematical formulas and measurement just various ways of being right more than wrong in identifying which industry groupings and which sub-industry groupings were actually outperforming the index over time.
John, take us then to where this is important for the advisor and ultimately the investor. What were the critical links that you were trying to solve for as an advisor to help investors either invest better or stay invested? How were you thinking about that?
Yeah, so when you look at overall performance for a retail client, individual investor, and Fidelity is a phenomenal study every year for the last 30-some years of comparing index performance versus the actual investor. What their actual rate of return is, and it's abysmal. The average investor earns significantly lower than what the overall market does. Well, why is that? Well, there's behavioral reasons behind that. And so oftentimes the retail investor gets in their own way from actually acquiring and growing their wealth. And one of the reasons why it appeared to me whenever we started actually surveying our own individual clients of our firm, Creekmur Wealth Advisors, and also outside people in larger group settings, people became very frustrated with the inconsistency of the performance of their underlying investments. So whether it was an actively managed fund, whether it was an index, they were frustrated. And so they were trying to find ways to actually add alpha or return to their portfolios. And in reality, they were doing the exact opposite. So one of the key drivers in our decisions, as far as on our due diligence process, was we need a strategy that actually has consistency in the rate of return on a month-in, quarter-in, semi, and annual basis. And, I started looking back at certain funds that had phenomenal 10-year track records. And within that 10-year number was hidden a number of years of inconsistency or significant underperformance. And so they may have had 1 or 2 years with significant outperformance. Well, that skewed their 10-year number. And in the midst of that 10-year number, there's decision points every single day for the investor to get frustrated with inconsistency and to make the human behavioral decision then to get out of the marketplace and miss the upside. So consistency of returns was one of our key driving inputs that we were looking for. And that was provided by the strategy.
Karl, you're the engineer. You now have to translate those needs into a process. Are these hard to incorporate or easy to incorporate?
It's fairly easy. I mean, once you got the method developed, it's like baking a cake following a recipe. I should add, however, that my fundamental interest in starting this many years ago is investment research and management. And yesterday morning, I was still doing a bit of research and refinement. I mean, the process is never done. So a big breakthrough came several years ago when I developed a set of spreadsheets to guide, because you have to record your data. A good guru for me was Dr. Alexander Elder. He pointed out the absolute emphasis, and I can't stress this, for any manager, have good records, keep good records. There's only 2 reasons to trade, either learn or make money, okay? And I have learned at my expense. And until you learn why you lost money, okay, you're going to keep throwing chips on the table over and over and over. So what you want to do is reduce speculation down to a probability. And we feel that we've got probability now on our side greater than 50%. The other thing about the portfolio and the entire process is that it is market driven. That means we take our signals from the market and we take what the market gives us or what can give us. We don't have anything that says it looks like, it seems, could be, next quarter, They're going to do well in 2023, all this other speculation. On the other hand, we do look at fundamental analysis on the characteristics, certainly the economic policies of the government, the fiscal policies and what have you. And we have now an opinion on interest rates. Okay. And because we structured the portfolio in anticipation of higher interest rates, and higher interest rates shot up. They went too far because we have a measurement system to determine excess movements. You're going up too fast, too far, and we expect it to fall back, which it did, to a rising trend line. And that's where we are today. And we have positioned a portfolio for that. Again, being market driven, we could change our mind on a dime because that's what the market's telling us. So we don't want to be late or early. The trend following strategy is going to miss the first 10% off the bottom and the last 10% off the top. Has to, because the trend has to change. And the question is, how do you determine that you actually do have a change? And Market Pring says, you go with the trend until the preponderance of evidence suggests that you have a change. Now, what the preponderance of evidence, you have to determine what factors are you looking for to give you that green light or red light. And
let's talk about that, Karl, because I think, that let's kind of dig a little bit deeper in the nuts and bolts of signals, because, a lot of people say the trend is your friend until it ends, but nobody ever tells you when it's over. Right. So talk to us a little bit about the types of signals you use to define a trend. Some people use moving averages, some people use oscillators or things like that, but talk us through some of those nitty-gritty on that.
Good question. There are about over 150 indicators in technical, I'll be generous, 50, but a lot, okay? And as your ad promoting the program showed an instrument panel of a single engine aircraft, there are 6 basic instruments to fly in any airplane. And the same thing is true in this business, that I've got it down to about 5 key indicators that work well. One is having strategic analysis, tactical analysis, and the intraday analysis. The strategic analysis takes away decision making. That's all it is. It doesn't tell you to get out or in. It just says you can't short in a bull market. It also says you can go long. But the key measurements, the next measurements, we used a thing called a modified MACD, and it's modified. One of the problems with the moving average, convergence, divergence that folks have brought out, you can't use it to compare that value when it's applied to another stock. So we have a ranking system that compares them all together. We've got a proprietary formula that allows you to compare the MACD of one stock to the MACD of another stock. We can get an idea how fast it's moving. We also have a measurement. It's called the first derivative. If you remember calculus and you take that and we measure, and it's the same thing as the tangent to a slope. And that's where we get inflection points when the tangent goes to 0. Then the key thing we use that I found very helpful is a Keltner channels. Keltner channels. You have to look it up. I mentioned, how do you know the market has gone too far, or the thing you're measuring is gone too fast, too far? All of us have been to a physician where they put a blood pressure cuff on your arm and pump it up and walk away, comes back, and you have a reading, right? And the guy says, well, my God, you're, 260 over 180. Mine is not that yet, but it's working on it in this market. The thing is, we have a similar method to determine that it's gone too far, too fast. And it shows you very clearly that it's out of bounds. And it's most likely moving averages tend to act as magnets. And if it gets too far, it gets pulled back in. So we have this measurement thing that it's essentially a channel, and it's adaptive, and it shows that it's too far, too fast. Once it gets out of the channel, we wouldn't buy it at all at that point, because there's a greater chance of it pulling back, which it usually does. It usually pulls back in the channel. The last thing we do is the last one it's probably the one that I would rely on the most. And this was brought out by a guy, Paul Charbonnet, back in the 80s, when this all started, computerized, early 90s. Paul Charbonnet came up with the idea of relative strength analysis. And he said the problem with market timing, which we don't do, is that you've got to be right twice. Once getting in, once getting out. And it's kind of tricky. He says, if you go to relative strength analysis, you've got a window of about 2 weeks in there. And that is true. You have about 2 weeks to get in if the trend is going. And if there's one thing I need to get that you could take away all the instruments, please don't take away my relative strength analysis, because it shows me. Because, for example, what I can do is compare a stock to a bond, which is one of our key measurements, is the stock to bond ratio. And is that curve change? You should have seen that chart when we had the crash in February of last year, okay? Or 9/11, or in December of 2018. We saw that what happens, the S&P began to underperform the 20-year bond. And that tells us people are dumping stocks and going into bonds. I don't know what they're going to do today at the low interest rates, but that's another story.
John, these are all great ideas. When I was at the business school at the University of Chicago, we studied these in depth. I've also found throughout my career that engineers really gravitate to this kind of insight because they understand how to put it into context. It resonates with the way that they think. But for you, you work with clients that are more than just engineers. How do you translate these ideas for yourself as you evaluate the strategy? How do you then communicate that to investors to take these complicated concepts and winnow it down into something that they can understand?
Yeah, that's a great question. What we really have to do and focus on doing, and Karl has actually done a great job over the years, is walking through story form. And some of that's actually been mentioned in a couple of different times today already, as far as on what the methodology is. And so if we think of a pilot who is leaving from the West Coast, he's leaving from LA and he's flying out to DC, and he is 1 degree off as far as in the path that he's on, well, then he'll end up in Bangor, Maine instead of in DC. And so the same thing holds true as that the manager walks through a mathematical process to identify the degrees or the changes that need to happen or adjustments that need to be made based upon the environment to get to the destination when we need to. And how do they do that? Well, they do that through the instrumentation. And we all have heard of a pilot being able to fly blindfolded, just having the instruments in front of them, or not being able to see because of clouds or darkness and being able to get to the destination. Well, they have a 6-pack as far as on the analog. They have 6 different instruments that each measure different things. And so the altimeter, and what does that measure? And we have thrust measurement. We have different measurements that the pilot uses in order to get the plane to its ultimate destination. Well, the manager has a similar process here. It's that they have measurement devices that tell them what is happening underneath the market, and then that helps them make decisions. However, as Karl said earlier today, even there's times whenever the pilot is flying, coming to land, and there is a truck, a fueling tanker, that is stalled on the runway. The measurement devices do not see that tanker sitting on the runway. And if the plane lands automatically, that will cause an explosion. That's not a good thing for the people on board the plane. And so the managers of the portfolio, then a certain level is reserved for them to interpret what is happening, big picture, whether it's geopolitically, whether it is a virus that is being spread, whether it is the Green Bay Packers winning the Super Bowl, if that ever has input. And so the manager, though, in all seriousness, does have the ability, based upon their experience and their knowledge of the environment, to be able to make changes to aid what is being revealed inside the instrument panels. And so that's an example for the average investor to be able to understand the strategy. They may not know the deep dive as far as in the channels and the Keltner and the relative strength and the moving averages and how all of that is calculated, but they do understand the instrumentation and how that does help the plane land to get to its ultimate destination.
Yeah, and Karl, one of the things I think is worth thinking through is the question of benchmarking, right? So you mentioned for people that maybe are getting closer to retirement age, a strategy and approach like this. But I think the challenge of anything that's very active and tactical is how do you benchmark it against something that's passive. So talk us through sort of how do you think about that question? How should that be thought through for investors?
Sure. We need to benchmark somewhere. And we felt that early on, I used to be chairman of the pension review committee for a major municipal pension fund for a city in Florida, and institutional. And you change your whole complex of thinking once you're dealing with pension beneficiaries and the longevity of an institutional pension and the impact that your decisions make on the benefits that the pensioners get. In this instance, the benchmark I asked the consultants at the time, I had a phalanx of consultants, and I asked them about benchmark, and they said, you're better off with the S&P. It's widely recognized. It has a variety of things, so we benchmark it. I said, benchmark it to the S&P 500. Why? Well, I need some way because, as John pointed out, the average fund would do the S&P. You could go into some exotic ETF or a mutual fund, but you need some consistent benchmark. So I picked the S&P way back when in 2010, and every year, I'm looking at my chart right now. I'm looking at every year we have a horse race. January the 1st, the bell goes off, the horses run out of the track, and at the end of the year, I want to see where we are versus the benchmark. And if we beat the benchmark every year and not lose money, okay, then I feel we've got a success in this, that we beat the benchmark. And that comes back to the issue of consistency. By measuring every year, are we consistent in beating the benchmark every year? That completely would reveal if we've had any bad years and some very good years, as you would when you begin to roll up your performance in 5 and 10 year standards. So benchmarking is very important. Lastly, that would address the average investor or what somebody reads and says, well, the S&P is up 10% this year. This is what he would expect if he was a buy and hold guy. So we wanted to compare ourselves to a simple buy and hold guy that is in a broad index like the S&P.
John, talk about fit. Where do you think of this as an allocation within your asset allocation? And also, how do you think about weighting it within a portfolio?
Yeah, great question. It obviously depends upon the goal objective of the individual client to see where it fits in. We do have some clients where the strategy on the SMA side, that is the entirety of the account. And so they may have asked us on other strategies, but it's held as a standalone for them, and it's viewed as the growth portion inside their overall portfolio. When it comes to a managed allocation for an RIA, we would view Euclid. So if you look at the package or the ETF product, that could actually be used as a core holding, as a replacement for the S&P 500 inside of the overall allocation. Whenever we look at growth, we would, and the reason why I'm going to say this because it's really almost a go everywhere strategy if you think about it this way, because Karl and his investment committee, they're looking at small, medium, and large cap. Mm-hmm. They're looking at value and growth side. They're looking at sectors and subsectors. They're looking at currencies. They're looking at interest rate product. They're also looking internationally. And so all of that is being measured and considered inside the strategy. So we would view it potentially up to a 25% to 30% allocation on a growth portfolio. And then from there, look to build the allocations around based upon the interest or objective of the client. And so we view it as core. On the satellite side, it would be more of if someone is wanting to have more specialized interest or technical interest, they could build around that. We do have a number, I've talked about other RIAs that are using it as the whole equity position. And they're simply using a short-term or intermediate-term bond to balance out the risk inside portfolios. I would say what this would not be is somebody is looking for a specialized strategy. If they're looking more for a meme investment or looking for what is the hottest thing right now, if they're looking to add extra juice as far as in their returns and they're willing to accept the extra volatility, this would not be a position to add. But if you're looking more for a core holding inside an overarching philosophy, this would be a replacement for the S&P.
Yeah, great discussion and analogies about how to keep investors engaged with an understanding of this strategy is just so important. Engagement with relatable concepts for managing a systematic process is at the core of a fund of funds strategy that has the goal to manage risk while searching for growth of capital. I totally get how this could be a core position for advisors and investors. In time, the strategy, if it does prove out, and that it can minimize the drawdowns or achieve alpha with security selection and sector selection, investors' confidence will be achieved.
No, absolutely, Dan. And that's a really interesting point in regards to analogy. And I can see how Karl's background in engineering definitely ties in to the methodology of the index itself as well. So great point.
My approach early on in this business was similar, actually. Listen, it's all about transparency and process. Too many people in our world speak about model building and make these things seem complicated when really, as an ETF strategist, all we are doing is working a fund of funds approach. Mm-hmm. It seems obvious, but this strategy is doing a job of an outsourced CIO or an ETF strategist on a systematic basis. So it's just about executing and outreach.
Absolutely, Dan. And I love the advisors from Creekmur Wealth Management and how they broke down how they put this particular strategy to use for their clients. So that was a very interesting topic as well. But I want to go back on Karl's background in engineering. And from listening to him speak, there's an interesting book out there called The Medici Effect that individuals of different backgrounds and industries taking the best practices and knowledge of that particular industry and applying it to others. And I can see where Karl's doing that in this particular index and methodology with his engineering background and applying it, the thought processes of an engineer into this particular index and ETF.
Yeah, using math takes a lot of the emotion out of decision making. Mm-hmm. Next up, our advisor guest, John Morse, talks about a charity that he believes in, New York City Relief.
John, who do you want to recognize today?
I'll tell you what, I have to recognize New York City Relief. And they work with the homeless, the growing homeless population in New York City, have been doing so for over 30 years. And they provide mobile meals in 6 locations with mobile kitchens all around the city, and including mobile cleaning and hospitality for folks that don't have a place to lay their head and get a good meal. So New York City Relief, stationed right there in New York City.
As we wrap up, we'd like to thank John Creekmur for his thoughts and Karl Ashley for his insights. And again, we thank Euclid and SIBO for sponsoring both the live ETF Think Tank Exchange and this podcast.
You can learn more about the ETF Think Tank and the Think Tank Exchange by visiting etfthinktank.com, your source for ETF ideas, thought leadership, strategies, tools, and growth tactics.
Until next time, keep the exchange going with your clients. I'm Kedar Wilson.
And I'm Dan Weiskopf. Take care.
The views and opinions expressed during this event are those of the participants and do not necessarily reflect the views of the sponsor or organizer. Information set forth during this event has been obtained or derived from sources believed by the participants to be reliable. However, neither the sponsor nor the organizer make any representation or warranty, express or implied, as to the information's accuracy or completeness, nor does the sponsor or organizer recommend that the information shared during this event serve as the basis of any investment decision, and it has been provided to you solely for informational purposes only, and does not constitute an offer or solicitation of an offer or any advice or recommendation to purchase any securities other than financial instruments, and may not be construed as such.